Morning, everyone who's joined us. Thank you again for taking the time to kind of hear what we're seeing in the design and construction world. This is Blair Tennant, Associate Principal with Vermeulens. We also have Richard Vermeulen, Co-CEO with Vermeulens. And today we're honored to have John D. Crombie join us from Cushman and Wakefield. He is going to talk to us today about the great accelerator for retail change, how COVID-19 has kind of impacted how we foresee the future of retail. A few things before we get started. Please mute your microphone if you're not speaking. We'd love to see you all, but we're going to have you keep your camera function off. Helps with the bandwidth. Please, if you have questions, use the chat feature and we will address those questions as they arise or near the end. As a reminder, we're going to send out this slide deck along with following the webinar, along with a situation report. So basically summary of what we've heard. And then lastly, as you all know, we are targeting the first Friday of each month to host these sessions. Our next one will be on December 4th. And with that, I'm going to pass things over to John.
Thank you, Blair. I just want to make sure to show my screen. Make sure that's working.
I can see your screen.
Yeah. All right, so can everybody see that now?
Yes, sir.
Great. Well, first of all, thank you very much, Blair and the whole Vermeulen team for having me come on today and talk about the great accelerator for retail change, the COVID-19 that's obviously had big impacts on a lot of businesses, but specifically retail has been hard hit. As mentioned, my name is John Crombie. I'm Executive Managing Director of Retail Services for Canada for Cushman and Wakefield. So I look after the business line across Canada. I do connect a lot with our US and in fact worldwide from our global platform in terms of what's going on from a retail perspective. And so I've put together a presentation today that's going to talk about three things. First of all, the economic impact that we're seeing through COVID-19, so the effects on rent, e-commerce, and consumer behavior. Then I want to look at the direct impact that we've seen on the shopping centers as well as retailers. And then finally, I'm going to end up with predictions and sort of what's next. And as mentioned, there is a PDF copy of this presentation that will be circulated afterwards because I'm going to go through slides pretty quickly, but there's a little more meat on it if you wanted to digest it later. So let's begin. The economic impact. I don't have to tell you that we're in the second wave right now, and as of yesterday, United States had about 166,000, or 2 days ago, 166,000 new cases. In Canada, we're at 4,600 cases. Certainly, even as a percentage-wise, if we always ratio of 10 to 1, we're certainly less in Canada, but still, there is a definite problematic with COVID having a second wave right now. When you look at unemployment and how it's been affected by COVID, you can see we spiked at 13%. We're now at 10.2 in August and trailing, hopefully back to 6.6 by second quarter of 2022. US unemployment currently stands at 7.9% in September, and you can see it hit 13.3 in May. But really, if you look at, there's 26.5 million people collecting either unemployment or federal emergency programs. If you calculate over a workforce of 160 million, that translates to potentially unemployment rate of 16.5%. So certainly detrimental impact. And certainly in Canada, we have seen absolute crazy home resales have surged in the last couple of months. Specifically, Toronto and Vancouver have continued to hit record highs. It has a lot to do, and I'll talk about it later, of the changing in consumer behaviors. But with these record highs, there's a lot of sellers out there in the marketplace that are willing to give up their homes, a lot of buyers to take that. So we suspect that it'll probably lose a bit of momentum in winter, but it's certainly been a big impact of what's going on. And the economic recovery begins to appear on the horizon. This was actually taken from Coresight Research, and they took Bloomberg consensus on from a GDP. And you can see they've looked at the US, Eurozone, Japan, and China. And the fastest uptick has been China, but they also were impacted sooner than we were in Canada or the United States. And they have actually had a bounce back in second quarter of 2020. The US was obviously the most dramatically hit during that 2020. But the general consensus is that by fourth quarter of 2021, we should reach similar pre-pandemic levels, according to what the consensus is saying. So now let's look at retail spending. I'm going to talk about both in the US and in Canada. So the Canadian monthly sales, this is year over year change. We continue to receive recovery. In fact, the numbers just came out for September this morning, and they're at 4.1%. So you can see the impact that COVID had in March, April, and May, and then the bounce back in June, July, and August. So on a good thing, and obviously September, we've seen the same. But what it does mean, especially with those negative changes, is that the year end for Canada will be a negative 5.7% decline in retail sales. It's the first decline we've ever had on record. So it's obviously, even those 3 months have had a dampening effect. When you look at US monthly sales, the pattern is very similar. And in fact, the month of September was 5.1% year over year sales in categories. The other side, you can see e-commerce, which just, and I'll get into it later, but just spiked at over 20% in terms of people jumped onto their computers and their mobile phones in giving up on bricks and mortar when they were closed or didn't want to go. And predictions of holiday spending this time of year, we always look at the holiday spending and what we estimate. In Canada, we are going to be having an estimated decline of 30.7% in total spending. You can see the different categories, obviously travel taking a huge hit on that. Interestingly enough, they're saying millennials are going to be spending more, but the Gen Zs are going to actually spend the least amount. When you look in the United States for US spending, Deloitte did the similar study, and they think that sales should rise between 1 and 1.5%, which is obviously lighter than we saw last year in 2019, when we went up 4.1%. And there's really two factors will have a big impact on Christmas sales. And retailers, they live for Christmas. A majority of retailers live for Christmas in terms of, people digging into their purses and wallets. But for the United States, it really depends on how much the rich will splurge and if the poor will cut back on their spending, which has generally been pretty strong. The other thing about Christmas spending and Christmas holiday spending for in retail, it effectively started in October 1st, which is really early. One reason is that a lot of retailers are trying to spread out either e-commerce or their physical sales in stores. Biggest issue that we're facing right now that retailers are facing is the fact that inventories in certain categories may be pretty low. Commercial rents, I'm going to look at both the US and Canada. In Canada, as a second quarter of 2020, overall, and this is all categories, not just retail, but industrial, office, and retail saw a decline of 2% statistically from Statistics Canada. And in some respects, the rent hasn't been keeping up even with inflation. So you can see the immediate impact that COVID had on the rents. When you look at it per category, and we have office, retail, and industrial here, you can see retail, which is circled there, is that Calgary is actually, and this is year over year, and taking that second quarter, saw some rapid declines in commercial rents by upwards to 15%. This is not just COVID related. This is obviously related to depressed oil prices as well. In the US shopping center industry, when we looked at base rent, and this just came out actually yesterday, year over year change, the third quarter of 2020, you can see that the base rents went down 8.9% for the third quarter, which is pretty devastating. We've seen total operating income decline by almost 10%. And thrown into that was expenses rose by 10%. And primarily that running a shopping center these days is more expensive when you have to have additional cleaning and staffing and stuff like that. And there was a real difference between malls, which saw a huge 28.9% decline in net operating income, while open air centers only 15.2%. And so we'll see that and what that meant in terms of pedestrian counts as well. In asking rents, we see a continued decline on continuously vacant space. This is taken from CoStar and Cushman Wakefield, some of our research. And as if you have a vacant space as a landlord, you're becoming more desperate, and you can see upwards to 25% reductions in asking rents. all this means at the end of the day, we'll definitely see a decline in rents overall for the year, estimating probably upwards to 15% for the United States and some of the projections. And I suspect that Canada will be following not too far behind that. When you look at rents received, so this is landlords and when retailers were paying, we have seen an improvement in the shopping center industry. 81.6% have in September received rents. It was down to less than 50% rent collection, and retail freestands or open air centers are upwards to 94. That's good. The bad news is deferrals. And what I mean by deferrals is that when retailers talk to landlords, they're taking maybe a rent holiday for a couple of months, but they're deferring that monies that owed out, and it keeps pushing it. It's like kicking the can down the street. And so the question is that do landlords, are they expecting this rent, and can retailers pay this rent going forward? So that's certainly something we'll be watching. So the impact on e-commerce. So as we showed earlier, that e-commerce has absolutely spiked. And for a number of reasons I'll get into, but you can see in the United States, upwards to over 30% of sales were done through e-commerce platform. And the projection is that for 21 and 22 and 23, we should see a subside in that as obviously bricks and mortar come back. In Canada, we do a fraction of e-commerce sales compared to the United States. And in fact, the estimate here is 8.7% for 2020. Prior to COVID, they were estimating only 7.7%. So it has gone up 1%, which is quite significant. And so we can see. Yep.
John, can we pause on that for a quick second? And maybe even the previous side, the Canadian side's a little bit surprising. But as we can see, the e-commerce percentage of total is you project it settling back down, which is interesting. But also the expectation of kind of the penetration of e-commerce into the overall retail economy. How far do you see that going? What are the signs? Like presumably the bulk of consumer spending there is in like consumer durables, autos, or something like that, where that might take much longer or maybe never in terms of e-commerce. So what do you think globally 10 years down the road, further even?
Well, you have to look at it per category, right? So apparel tends to be very high in e-commerce, and things like obviously online books and electronics tend to be a little higher. So you got to look at it per category. Even in pre-COVID, you took e-commerce numbers, say for England, London, they were over 20% in the last couple of years. So they've seen that. It's hard to believe that you'll get to 50% like as an overall average. So I think probably the 30-35% may make more sense going forward. A lot of it also has to do with the fact that the e-commerce is not just direct-to-consumer brands, but the retailers are doing omni-channel. So they do have their bricks and mortar, but they do have also their e-commerce platform. And the success going forward of any retailer is employing both of them. The other thing about e-commerce, it's not a profitable business. In fact, as you know, many years, Amazon has not made money from it. They've just grown in rapid increase in revenues, but it's a very expensive venture to get into. And so at some point, you know, the idea that the e-commerce platform is going to have to catch up in terms of its pricing to the bricks and mortar for all that, especially in the delivery of last mile. Does that make sense? Have I lost you, Rich?
Yeah, it's making some sense. So I'm hearing that the ultimate penetration on e-commerce is gonna cap out in your view, and prices might even push back.
Correct. And so here's a study that was done by Braze and Wakefield Research, and they, you know, even as stores have opened and reopened, the likelihood of people continuing online. And they're seeing globally like 30% will still continue to shop the same amount or more. And the top three reasons is convenience. We've learned how easy it is. Second is that we want to limit our exposure to health threats. And third is the better pricing. But I believe that idea of better pricing will change, just for the reasons I said earlier. And in fact, I mean, I guess it's easier for price comparison online compared to going into stores, just how easy it is to do. But that is the three reasons why. So let's look at consumer changes during COVID-19. So never has there been a time in modern history when every person is seriously worried about the same thing at the same time. It's actually from a psychological point of view, and this will be studied for many, many years. But really what we've seen is just our attitudes of how safety, for example, have changed. I jumped in the car in the 60s and my mom never strapped me in, but now we have these lamps that sterilize our cell phones when we bring them home. And so I think this generation and us going forward are really going to be more health conscious. And there was a study that was done on changing consumer patterns. And frankly, we talk about this in demographic and psychographics all the time, and consumer behavior was one of those things you talked about, but it just was like watching grass grow. It didn't really have rapid changes. But in 9 months, we've seen huge changes which have affected the residential housing market and a whole bunch of other stuff. So these are summations that are affecting retail. So the first one is house is our castle. So we're ramping up in home improvements. That's why Home Depot and Lowe's have just exploded. People are remodeling their houses and their bathrooms. As we all work from home, a lot of us. We hear those squeaky doors and those walls need painting. So that's having a big impact on those particular sectors. Again, back to healthy living, and where it's like wearing a seatbelt. And so that's going to have an impact on companies that we're going to be supporting from a health perspective. This whole idea of urban exodus, it's questioning why we need to be in big cities, and maybe we can function from a cottage up in Muskoka, or we don't want to live in a 500 square foot condo, and maybe moving out of the city makes a lot of sense. And finally, slow living is killing fast fashion. Fast fashion has had its issues for many years, but the pandemic has absolutely flipped the switch on this. That many of us are just wearing the sweats all day long, and the whole idea of staycation and quiet nights in is becoming cutting any conspicuous consumption. So this is will have some impact on luxury brands and general retail as well, but good for online and sportswear. So when we look at the impact in shopping centers, not all retail centers are affected equally. This is actually a study done through mobile data. It's called Out and About from a company called Environics, and they looked at, just in this case, the city of Vancouver, but this has been pretty consistent throughout Canada and the United States, where when we do go out, we're not going as far, and what we are supporting more is local, which is the convenience store, convenience retail, and neighborhoods retail. They're still down, but they're not as down as the super regional, which is defined as 750,000 square foot shopping centers, and regional being under that, 500 to 300 and 750,000. So there's definitely a change that we're having less travels to the stores, but we're supporting more local. The good news is in many cases is that the idea that conversion rates are higher. So when we are going out, we're very purposeful in our shopping. We get in, we get out. So that's helped our basket size for retailers. At least there's helping to survive in those particular areas. And we look at traffic counts. Again, this is pedestrian counts through data. This is US data in various categories. It supports the idea. You can see the top line, there's home improvement, are seeing more people than they did last year. Electronics has been bounced back pretty well, but what hasn't is obviously fitness and dining. And we've really seen this. We manage, Cushman & Wakefield, we manage about 16 million square feet across Canada. And we looked, in this case, it's Devonshire Mall in Windsor, Ontario, and we looked at the prime trade area, which is defined as 70% of the visitors to our mall. And this supports my first slide I brought up, is the idea that people are focused locally. When they're going out, they're not going as far. And you can see in 2019, kind of the area that we would draw from in terms of our mall. And then today, how much shorter that is, how much smaller that is, I should say. And so we expect to see this going forward a little while. Obviously, our challenge is how do we increase that in time? But that's really going to be changing only by consumer behavior and how safe people feel about going out and about. And indoor versus outdoor malls, I mean, this is done by Placer AI, and they've tracked people going into indoor and outdoor malls, and there's a stark difference. Outdoor malls, it's down 24%, but indoor mall count, people coming there is down 37%. So quite a big difference. And again, this becomes from a safety perspective. So what's happening? Well, we are seeing definitely more curbside through BOPIS, so buy online, pick up in store. We're seeing this to be enhanced. And in fact, not only buy online and pick up in store, but buy online and pick up in center. And we're seeing a lot of shopping centers looking at creating common pickup areas for all their retailers, or most of the retailers, either in small lockers, as you can see below there. And the other thing they're working on too is how do you enhance it that when someone's bought online, but they come to the center and they need that impulse buy. So how do you design things? So there's ideas of having these pickup lanes. You can walk in and pick up other items that you perhaps forgot, which obviously increases the sales. We also know that in the shopping center is that the implementation of technology is going to increase. And there's really, the main reason is to save money from a landlord's perspective, if you can go on a technology platform. And second, it's really appealing to the consumers that are obviously more mobile adapt these days than ever before. So here's just an example, and I'll leave it with you eventually, but to read through. But the idea is you come to the mall, you pay for your parking, you know where to go to minimize your trip inside through wayfinding features. You pick up your shirt, you drop off your shirt for a return, you pick up the one you bought. You notice when you're leaving that robots are cleaning the stores, and you get a post-store experience by a coupon sent for your next visit. So this whole idea of implementing this technology in retail malls will be becoming a big thing, a lot of money being spent there in the next while. And this really comes into what's the future of the shopping mall. And historically, the shopping center was an area of just transactions. You go in there and you buy. The landlord leased space to the retailer dealt with the consumer. But we see it changing, that the owners and developers are really the lifestyle architects going forward. And they'll be bringing in, it becomes the hub of daily life is what the center should be. So it's the whole idea, again, of local support. So this community gathering, offering food and entertainment, which is not going away. Yes, it's been impacted, but that's going to be a reason why to go to the mall. The whole idea of discovery and recreation for fitness, which will bounce back, and discovery, providing things that you can't do online and that you do in store. And of course, shopping will be there, the transactional side, and the whole idea of fulfillment and logistics, and I'll get into that. But this is the shift that we're seeing, and we've seen for a couple of years, of how the shopping center mall of the future will occur. So let's look at the impact on retailers. Well, the bad news is U.S. bankruptcies will far surpass the Great Recession. We're predicting that there'll be in excess of 80 bankruptcy companies for this year, and you can see historically how much higher that is, unfortunately. What happens in the U.S. impacts Canada because 50% of our retailers are foreign-owned, mainly U.S.-owned. And when they are closing, they're supporting their local countries, which is the U.S. In many cases, they're just closing down Canadian entities, and we're seeing that day in, day out. Ultra Beauty just closed a lot of stores in Canada. Yankee Candle's the same thing, so it's pretty consistent. And we're going to have a substantial amount of retail store and restaurant closures. You can see again historically what we've seen last year at 12,000. I thought that was bad. And the forecast this year, even the likely case scenario, is the 30 to 35,000. So expect to see a lot of uptick in vacancy there. In Canada, we're not immune to it as the United States, and you can see year to date, we have 1,633 closures. Compare that to last year, we only had 646. So we're almost 3 times as many store closures and over 5 million square feet. So the effect just continues both in the US and Canada. And as a landlord, we constantly look at the overall sector health of the risk of space being returned to the market. And you can see the greatest risks. These are apparel, which has been really tough, through the COVID pandemic. Bookstores, craft, department stores are the ones that we continually watch for. As a landlord, you watch for, you want to try and support them as you can, but they're the likely candidates. The lease sectors, you're delighted if you have this. And what we're seeing with landlords is that they're really doing a refocus on their tenant mix in, what's essential, what's non-essential, and really trying to how best to preserve their NOI. A lot of it is trying to go to the sectors, in some cases have enough that have least risk, maybe bring down some of your apparel retailers, which you'll expect to see going forward. But it's all on, again, mitigating your risk. And we've definitely seen in the suburban market is getting a big boost. This comes back to what I said earlier about that people are being more local. So where they live is the suburban market. So they're supporting a lot of the suburban retail centers. And when we talk to landlords, retailers, many of them are concentrating on the suburban locations and not opening their downtown locations because of this phenomena. And this has been occurring in New York, worldwide. We've seen it time and time again. And so consequently, less people in the cities affecting urban real estate. This is, again, out and about data, which gives us an idea of who on a weekly basis are moving in. This is for the Toronto area. And you can see Toronto overall is down 500,000 people. And when you have office buildings in the downtown core at 10 or 15 or 20% occupancy levels, this is having a detrimental effect on urban retail. And so it's very tough in a lot of places. And if you're in the downtown core of major cities, you'll see many of them boarded up, unfortunately. And unfortunately, most restaurants are operating at a loss. The study done in Canada, but it would be same in the United States, is that 6 out of 10 restaurants are operating at a loss. Unfortunately, when you got to put your lights on and heat up the ovens and cook your food and staff, and of course, having mandates of how many people you can have on the patios or within the centers is having a huge impact on the restaurant business. And especially as a second wave approaching, this is very tough. Many of the restaurants, margins are low, and if they're independents, have very few lines of credits and resources to keep them going. In Canada alone, we've seen over a million people lost their jobs in that sector alone. And gym memberships are on the decline. Is it permanent? I don't think it's permanent, but the gym memberships for a while will be working at, once they're able to open in any meaningful way, will be at least at 50% capacity. We know a lot of the gyms are trying to negotiate lower rent during this time to keep alive. We're also seeing that many of the gyms, people have actually multiple memberships. So you may be, in our market, be a member of Good Life, but you also may be a member of Soul Cycle. And people are really evaluating that and just keeping one of their memberships rather than having 2 or 3 memberships. And some of the premier gym memberships have seen big declines. And I'll have to tell you, theaters have fallen off a cliff. Cineplex in Canada, the revenues are down 95%. And until there's a vaccine that people feel comfortable going back to the theater, this will be a very tough area right now. And we're still sensing a tension between landlords and retailers. I can tell you when the pandemic hit in March and April, a lot of landlords and brokers like ourselves, it was all about rent holidays, rent relief, and those are all the discussions. And the larger landlords probably had 700-800 calls and discussions with the retailers. Unfortunately, some landlords weren't reasonable and some tenants weren't reasonable. And so this tension just started to build. And you can see in this case for HBC, Hudson Bay is refusing to pay rent, even though they're open, even though they're e-commerce trading, but they're not paying rent. So in our market, Oxford's and Cominars, and there was another landlord even today, have taken the task to slap a lawsuit on them. So expect to see this tension going on for a little while. The other thing we're seeing is landlords are acquiring retailers, and this is not necessarily new. It's happened for 20, 30 years. And so example of Simons and Brookfield have looked at buying JCPenney's for rescuing them out of bankruptcy. Why are they doing that? Some cases they're protecting their exclusivities when your major is gone. Many other retailers have the right to vacate or stop rent. So it's protecting your centers by that. But I think a lot of landlords see the upside on it. They're picking it up at pennies on the dollar. And in some cases like Brooks Brothers and Forever 21, some people have actually made some good money from this because they know how to run retail centers and they know how to run retailers. And so they see an upside, and hopefully the pandemic won't last as long and they'll be able to sell out in time to a venture capital or somebody else. And because of that increase in vacancy, the 30,000 in the United States and 1,700 to date in Canada, what we're seeing is more pop-up retailers are filling these vacancies. It's called specialty leasing. And so it's consistently across the board, we're seeing this. And a lot of it is catering. I think this is actually going to be a huge growth area for retailers to get into markets that they haven't been able to get into because either the vacancy wasn't there or the cost was too prohibitive. And so we're seeing more of these pop-ups coming in there. And Cushman & Wakefield in themselves have been helping Tanger Outlets in some of their vacancies and again, putting some of these pop-ups. And pop-ups eventually could lead into full-time stores. And so I see it as a real growth vehicle going forward. And you'll see this with direct-to-consumer brands as well as already established brands.
Hey, John, what's the definition of a pop-up?
A pop-up is it's a short-term stay within a shopping center. So a retailer may open up for as short as a couple of weeks to a couple of months. And they set up their store. It's like a physical store, but it's only a temporary lease. We're doing work with Canada Goose, and we're doing a number of pop-ups over in Europe. And they want to, obviously, when the winter's coming up, they want to make the pop-ups there so they just have more eyes and ears out in the marketplace for consumers to see their product. Peloton's been actually a big one. Peloton's have been a real winner as we've been buying lots of Pelotons, but they've, in the last couple of years, have utilized most of their new locations is pop-ups to get their product out to the marketplace. So the other thing we're seeing is that retailers are investing for better customer service. And what I was saying about the e-commerce, yes, it's increasing, but really the people that are doing e-commerce are the ones that also have bricks and mortar. This is just one example, Walmart. I mean, they're investing $3.5 billion over the next 5 years, and they're increasing their omni-channel capabilities. And that's having a physical store along with an e-commerce platform, catalogs, they're not dead, and people are still doing that, online flyers. And it's, again, how do you connect with your customer? It doesn't matter through a physical store or online or through the mobile phone. It's having those multiple contact points. They also are creating smarter stores. So we talked about AI for landlords. We're also seeing a huge push in technology for retailers. And again, why are they doing it? To engage their customers and to make more money. Distribution centers are becoming a big thing of, the pandemic has proven the fact that if you only had supply chain and from 3 countries and one of your factories in Wuhan, China, you better make sure that to have redundancy, you look at 10 locations. We've seen a huge spike both in the United States and Canada on the industrial platform as it relates to DCs. And the retailers are realizing that they need this redundancy in place. And again, state of the art. So expect to see more of this going forward for many retailers. And e-grocery.
What are we looking at in the picture there, John? Is that like a distribution center with a storefront, or?
I don't know what that was. It's from their press release. It does look like a DC, absolutely. So they probably have a small little office component attached to the large DC. And and even Walmart. Well, I'm going to get to it in a minute. Actually, I'll get to it in another slide, so I won't repeat myself. E-grocery, as we know, that has been the real winner in the pandemic because it's an essential service. And so because of the changes that have been rapidly evolving, the grocery specifically has been looking again at ways to how to reevaluate customer engagement for in-store and e-commerce experience. And so we're seeing a lot of design right now to be implemented for grocery stores going forward. And you can see in this case, they're talking about micro fulfillment. So again, they'll operate either a home delivery or a pickup delivery in that. Again, how to bring people safely into the store, that they have the right distancing, and creating areas for inspirational or cooking classes and things like that. So we're seeing a huge change, and especially as it relates to the grocery sector. And again, the whole fulfillment, and Rich, this is what we're talking about, is that, in second quarter of 2020, the fulfillment side of it, so the pickup, the curbside, has been a real savior for a lot of companies. In fact, Home Depot saw an uptick of 60% on their e-commerce platform being fulfilled through that, where people just drive by, pick up the product, and move on. But so has Best Buy, so has Ultra Beauty, so has Nordstrom. And we've seen this whole idea of the fulfillment. And Amazon is who tends to lead this are putting up 1,000 new warehouses in suburban markets. This is all has to do with this last mile delivery, which is the most expensive component of the e-commerce platform. And so by having these warehouses and smaller DCs, as they get them out there, that they put them in neighborhoods with populations of 1 million, 2 million, they can get them within a very short delivery time, hopefully in a cost-effective way. And we've seen, and it's bizarre, but we've seen this thing called revenge spending in the luxury sector, where it started actually in China when the bounce back came and people went to the luxury market and they started spending. And we've seen it across the board in Canada as the stores and shopping malls opened up. Yorkdale Shopping Center, which is probably one of our premier malls, their luxury spending is on fire. You go into the mall and yeah, there's obviously less people, but there's lineups for the Gucci's of the world. And so people are spending. And what we are finding, again, consumers, when they're spending less products, but better quality products. Another line that I heard is that when you're sitting on Zoom calls all day, you might as well have bling bling on the upper half of your body, because that's the only thing people are seeing these days. But it's been a real phenomenon. We're seeing it worldwide. Overall, luxury spending will be down, but this revenge spending seems to be continuing, at least for the short term.
Yeah, I'm thinking that's backfilling. If you're not at the restaurant and those kind of luxury things, it turns into a luxury purchase.
Yeah. And so as I finalize here, what's next for retail? Well, their whole idea is when you have too much excess space, you look at converting to office. This has been discussed for some time. This is interesting at Hudson Yards, which is owned by Oxford, in part. The Neiman Marcus store, and Neiman Marcus is going through its workout plans, but Facebook leasing 188,000 square feet of space. You know, in the United States, more in Canada, we've seen the whole WeWorks or Industrious taking over old vacant department stores. We expect to see more of this going forward. The office market's a whole other discussion. Definitely it's on pause. Interesting, just as a side note, from a brokerage side, we're actually making more money. We're making actually great money in industrial. Retail is down, but our office is down the most because no one's making any plans right now. Lots of sublet space coming on the market, but no one's making plans because they just want to see how this pandemic's going to play out. In the restaurants of the future, zero contact. This is just one concept, a company in the Canadian market called Paramount, and they're making this new area where you order online and you go and you pick up. It's like a vending machine for all intents and purposes. In fact, the vending machines was started in the 40s, so it's almost like a full circle coming back. But the whole idea of how do you come in there, go to a box, pick up your food, move on, and you minimize any contact with people. So expect to see some of these ideas going forward. And we're seeing these alternative uses. Again, we're getting back department store spaces, and retailers are pretty creative, and there's a lot of new creative ideas that aren't traditionally seen in centers. And I like this, a doggone good idea that this one's called Bark Social, where they take upwards to 25,000 square feet. They take either interior space, depending on the market, or exterior space, and a place to take your dog to have fun, and hopefully you can have some interaction with people, and hopefully in a safe way, either a beer or coffee. So these are an example of a alternative use that is becoming a big push in the retail side of things these days. And we're seeing the revival of drive-in movies. Who would ever thunk it? But this case in Montreal, where actually quite a large enclosed mall is under construction. They've paused the construction right now. It's 1.2 million square feet, and they've elected in this case to in their parking lots, which were already in place, put in drive-in theaters to keep people safe in there. Walmart did the same thing, and a lot of their stores around the country. And again, it's just how do you drive more people to your centers? How do you make some money out of it? Again, some unique and interesting ideas. And I thought this is kind of strange, but in Paris, Champs-Élysées, they're putting barriers to ensure that people aren't too close to one another. So again, people and retailers, and listen, retailers I think are some of the most creative and the ones that look at the business differently, try new ideas, are the ones that are going to succeed in this. And retail is not going away. We're still going to have our bricks and mortar store. They're still going to have an e-commerce platform. Again, back to this whole omni-channel. But it's ideas that just you have to keep innovating and move forward. And I love this. I mean, can the Rolling Stones save retail? And this is a flagship that was built in Carnaby in London. And I don't think this will be coming to the US and Canada too soon. But again, it gives an idea of just these aren't traditional retail that we've thought about in the past. And so it's, rock bands now creating, a unique environment. And this is an experience store as much as obviously it'll have transaction values to it as well. So I just thought it quite interesting. This is a summary, which when you get a copy of the presentation, that you'll get an idea. And this is effectively all the stuff that I've just talked about and what we expect to see in 2020 as well, moving into 2021 as it relates to percentage rent deals, deferments. We'll expect to see more TIs in the marketplace, a lot more free rent. The big thing about retailers these days is that they've drained their capital reserves. So when they do start expanding again, they'll be looking to the landlords to be paying some of these TIs. And the big thing they'll be going forward is your covenant. And the stronger your covenant, the better chance of getting some of those cash to build out your network going forward. And team, the Vermeulen team, that is it.
Well, John, thank you so much. That was extremely informative, really great content. Daniel, do we have any questions for John?
Sorry, I was on mute. No, we don't.
Okay.
I just answered every question so well.
Richard, any closing remarks?
Yeah, I think probably I'll be looking at this with John a little bit more, kind of pencil out what this is obviously an accelerator for change. There's a lot of balls in the air that we're looking to see where they land and then how they interrelate with all the other balls that are going to be landing. But I think I'm going to, ask John to spend a bit of review time with me on this to kind of pencil out a trajectory for this and how it fits into the construction economy and the overall economy. Because there's some, we're in a cost phase right now, but the benefits that are coming down the pipe on retail, as I asked earlier, where do some of these trends really plateau out, and where do we end up, and what does the world look like? You could call it post-pandemic, but you could also call it kind of pandemic ready, because as we all know, these little mini pandemics have been happening on a regular basis, and it's going to be, and in the future, it's going to be something that we need to be resilient to. So how that stuff pencils out is going to be a big economic question for both construction and the overall economy. And not only that, I'm not going to let John go. If he's got information on the office sector, information on the industrial sector, those are big pieces to the built environment, and we're going to want to get a bead on what's going on there. So those are all future things I want to be getting a good look at.
Question actually just came in, and the question is, how do you think all these trends will affect the new construction and commercial renovation market, both post-COVID and looking down the road 5 to 10 years from now?
Yeah, well, the one thing I didn't bring up is first of all, what COVID has done for retail specifically is in 6 months is made changes that were already in place that probably would have taken 6 years. So again, it's been the great accelerator. And the one thing that we've seen is that consistently, both in the US and Canada, is looking at the retail and how do you right size it. And it's adding through what we, as you know, is mixed use development. And this is a huge trend that's going forward. In fact, a lot of the plans that were already in place in pre-COVID, we've seen a real acceleration on landlords and developers pushing forward their mixed use plans. In some cases, not only opening portions of a shopping center so they can start tearing down quicker. So that's obviously going to increase the construction side of things. And it's adding office component, it's adding residential, it's densifying and intensifying the site. And so we're seeing that as a huge, opportunity from a construction side going forward, and that'll continue for many years to come. And as I say, bricks and mortar isn't going away. And the whole idea of mixed use is that consumers love it. I mean, people do like living there. They like the convenience of having the retail close by. Office people like the retail nearby, and some people live in the residential properties near adjoining to the office components. So it's a really sought after type of product these days, and I think that'll be a big change. The second thing, if the shopping center doesn't go into a mixed use, and I didn't bring up here, but the whole department store industry is going through a huge transformation. In fact, you'll see where as upwards to probably another, I think in the United States, I think there's like 1,200 department stores, and I think you'll see probably half of those gone in the next couple of years. And so owners will be looking at ways to convert that. So it's a great construction project. I know in Canada, for example, the Sears locations, let me back up. We had Target that went belly up, and then we had Sears a couple later that decided to leave. And many landlords kept the Target boxes and worked around them, but they were very expensive from a construction side to do so. So when they got the space back from Sears, they ended up just tearing it down because it was cheaper to work in that respect than it was to work with the existing structure. And I expect you'll see a lot of that going forward, that they'll tear down all these old department stores and look at, again, alternative uses, which again could, doggy daycare kind of things like that. So that'll really be a big push on that as well going forward from a construction side of things.
Great. Well, if there's nothing else, want to thank you again, John, for your great presentation. I hope everyone has a great weekend. Next week is Thanksgiving. I hope everyone's taking a good break. And we will see you at our next forum on December the 4th. Thank you, everyone.